Why are we not operating more like a venture capitalist? Are we missing out on opportunities? Is our mission to generate wealth by investing in fundamentally new concepts and engineering practices with large impact? Is our mission better achievable through the kind of investing we're doing now, or should we do venture capital investing? This is the question. I was inspired to think about this because I listened to a conversation between Jeff Myers and Farouk Abbasi, two venture capitalists. Jeff Myers runs the Software Engineering Daily podcast, and they spoke about this. So it kind of made me think, and I want to discuss this in this episode. This is one of those episodes where I truly don't know exactly what I'm trying to say here. I know my thoughts. I know how I feel about this, but I'm not sure if I can articulate it. So this is a very good exercise also in the making of a thought, in the formulating of a thought, which is sometimes more important than actually just having the thought, because once you formulate something, you can actually act upon it. This is Not Even Wrong podcast. It's July 30th, 2021. This is Krim Delco. For the day, the fund is up 1.6%. For the year, we're now up 2%. The market for the year is up 17.5%. We're underperforming by 15.5%. Well, let's talk about this particular topic. So, first and foremost, what is it we're doing? What are venture capitalists doing, and why is there potential to miss out? We at Orange Capital Partners invest in publicly listed companies with real-time NAV. We are in the business of investing in fundamentally new concepts and engineering practices. So as far as that's concerned, we're pretty much in line with what venture capitalists are doing. The difference is venture capitalists are coming in much earlier. They're involved in the company building process. They're using their networks to hire people. They're trying to contribute more than just capital to the companies. This is the theory. This is what it says on paper. Farouk talks about this. He wants to give people an opportunity to take risk. He wants to de-risk their entrepreneurial activities. This is clearly something that we at Orange Capital Partners are not able to do. Once these companies come public, they usually have de-risked to the point where at least their existential risk is, I would say, it's not that high. Now, there's always existential risk. I don't care if you're Elon Musk, you have existential risk, because no matter how rich you are, you want to achieve certain goals. If you don't achieve them, you consider yourself a failure. So from that perspective, existential risk is probably a relative thing. But I think what Farouk is trying to say is that he wants to really enable this particular entrepreneur, maybe from India. Farouk is Indian. So imagine you're an Indian entrepreneur, you work for a large company there, you have a lot of social pressure to make money and all that stuff. And then he wants to de-risk that type of thing and give somebody a chance to start their own company. This is theoretically what venture capitalists do. If we go to, let's say, the leaders of the pack right now, Andreessen Horowitz, they are certainly in the business of building brands, of building entrepreneurial brands, of building, how should I say, they compare themselves almost to a Hollywood talent office, where they attract the talent and then they build projects, help them develop projects where they literally evolve as a brand, and the company and the wealth generated through the companies that these entrepreneurs actually do is almost like a movie for them, or a music piece. I think that's the way they see it. That's how they spoke about at least their idea of founding. Andreessen Horowitz was sort of trying to align themselves with the talent business in Hollywood. And then just instead of movies, of course, what they're really building is companies. Excuse me, I'm drinking some coffee, so I'm not going to edit this. Apologize for this. But that the point here is, we at Orange Capital Partners are not in that business. And the question is a couple of fold. First and foremost, are we missing out? Second, can we achieve generating wealth maybe better by writing those, $100,000, $200,000 checks in seed or even pre-seed? Farouk and Jeff talk about pre-seed, things like that. Or should we stay where we are? And the answer for me, at least right now, the way I think about this is, of course, no, we should stick with what we're good at, stick where we feel comfortable. And this is something Farouk said. Farouk said he believes that as an investor, you have to be yourself. You have to really do what you think you can do best, where you feel comfortable. And this is very important. We at Orange Capital Partners, we're incredibly comfortable with electric cars and self-driving cars, autonomous vehicles, application of AI to robotics, and then on the other hand, also the digitization of life sciences to CRISPR technology and genome sequencing. Those are the two areas we're comfortable in because we've been working on these areas for a long time. We believe that the ability to digitize life science, for example, through CRISPR, is a tremendous opportunity. So I think we follow that idea. That is certainly something that we follow at Orange Capital Partners. We're not spreading ourselves around. There's a lot of opportunities out there. There's a lot of potential money makers. For example, we have companies like Square. We have companies like Airbnb. We have companies like Shopify, Amazon, Facebook, Pinterest. There's, for example, recently I came across something. I read an interview where the Snapchat, or Snap it's called now, the company Snap, is being sort of described as a leader in what is it? It's not virtual reality. It's sort of that crossroads between reality and virtual reality. So, things like trying on clothing virtually, things like that. They have this technology. They have almost like a white plate technology for people to do that, and there's a huge industrial application for these things. So what I'm trying to say is there are lots of companies that we think have the potential to make money, and we don't invest in them not because they're bad companies, but because we don't feel comfortable investing in them. We need to feel the ability to add value. We need to feel the ability to almost, first and foremost, meet the crucial people of the company, and invest in their companies and ask questions that are relevant to them. That is one of the main cross checks that we apply at Orange Capital Partners. If I can't ask some relevant questions that somebody like a CEO or a founder would find relevant, then I shouldn't be investing. So, for example, Caribou Bioscience is a company that we're going to invest on next Monday. They just went public. It's a company that is applying CRISPR technology in allogeneic cell therapy. So what they're doing is they're creating off-the-shelf cells that can be used for immunotherapy in the fight against cancer. So they're building killer cells that they hope they can inject in your body, and those cells can go and kill the cancer. What needs to be done here is a couple of things. First of all, foremost, those cells have to be programmed so they actually they detect the cancer and kill it. And second, also, your immune system has to be kind of tricked in a way that the cells are programmed so your immune system doesn't reject them. So there is a programming problem. There is a huge potential for this, because if you solve this programming problem, you can lower the cost of allogenic cell therapy in cancer by probably several orders of magnitude, and the efficacy could go up a lot. So this is true disruption. And the questions we would ask the founders or CEOs is, of course, how can you solve those problems? Those are the key problems. Can you program the cell to kill the cancer, to detect and kill the cancer? Can you make it so your immune system doesn't reject it? And also, can you do it at scale? How can you use CRISPR to iterate fast and lower the cost? What is the difference between your CRISPR tech and some other CRISPR tech? And then what is the delivery? Those are the questions. They're not questions that are, let's say, at the deep level of engineering, but they're questions that I'm pretty sure any kind of board level questions that I think we can ask. So we hope that we can be relevant as far as that's concerned. We hope that we can inspire maybe also people, in this case Caribou. Maybe we can ask them, okay, are you guys building a platform like Intellia? Now, I know Caribou has a stake in Intellia, so of course they are probably familiar with this company, but Intellia is one of the companies that we are very fond of, that we have a large investment in. And part of the reason is because they're using CRISPR technology in a very smart way, also in a platform way, which of course increases the potential for them to be to have efficacy, but also increases the potential for them to generate wealth. So that would be one example. We've had several examples with Tesla where we were able to ask relevant questions. At the last AI day about 3 years ago, I asked Elon Musk if he thinks LiDAR is irrelevant or not, and he gave the answer that has been since then touted all around the media, that LiDAR is a crutch and that it's a bad thing, etc. Of course, by now this question might be a bit outdated, but I think asking relevant questions is part of the asset test if you actually should be investing in a company or not. It's also a very good test for yourself, for you as a fund, to understand, okay, am I still behind the 8 ball here? Can I be relevant as far as knowing what are the big questions, the big crucial questions that will lead from whatever stage we are now to the next stage, and so on and so forth, where wealth generation is sort of evolving along that line. And if I'm not able to do that, then I'm not able to be relevant, and then it becomes kind of a gambling game. Take two examples, two very good stocks. One is Snap, the other is Shopify. Do I care about augmented reality enough to ask relevant questions? No. Do I care about online shopping, I don't care. Even as a customer, I actually don't like online shopping. I find it ridiculous, and it's one of those things. I almost feel like we're in a paperclip economy here, where instead of going to retail stores and buying things, which is a much nicer experience if it's done well. Nice retail can be done extremely well with nice malls and restaurants and socializing and meeting people, versus this online shopping where we buy 10 things and return 9 things. It's terrible for the environment. It's terrible for social interaction. But anyway, so I don't care about it, and it's fine. I'm not emotional about it. I just don't want to be involved. So I think I need to be involved in things where I have a personal interest, a personal, almost a personal, a personal link towards and the two big areas where we're invested right now, both I have a very personal relationship with. One is energy transportation through Tesla. Energy has been at the forefront of my life. My father has been in the energy business. He worked for a Swiss company, ABB, and he was building power plants and networking technology, electrical networking technology across the world for decades. As a child, I grew up listening to that, talking about that, and now I'm investing in the next level of electrification of transportation and decarbonization of energy. As far as life sciences is concerned, I would say my link there is when I started on Wall Street, I was actually assigned the biotech space just because nobody else wanted it. This was in the late 90s, and I was able to participate in some of the biggest wealth generation in the biotech space, namely when Avastin was approved or found out or approved, I forgot exactly, as a drug to fight cancer. Genentech really went from 20-30 billion to 100 billion in no time, which for them back then was a big deal, a lot of money, a huge money maker, and it sort of propelled my career on Wall Street. So I have a little bit of a link to these types of situations, and that's why I feel comfortable with those situations. That's why I think I can be relevant. That's why I enjoy learning about them. That's why I enjoy being involved. That's why I enjoy taking courses. I took courses in genetics. I took courses in genetic sequencing. I took courses also on the AI side as far as Tesla is concerned. A lot of courses from machine learning to many other areas that I just feel like are relevant to the Tesla situation. So I cannot emphasize enough, and I want to paraphrase Farouk here, you have to be yourself. You have to find your own thing that you think you can do, and then it doesn't mean you're going to be successful, by no means, but it certainly gives you a much better chance. I want to say one more thing. I am not a fan of this idea that if we set up enough talent pools, incubators, pre-seed, post-seed, I don't feel like throwing a lot more money at talents will generate more wealth in terms of generating successful companies. Here's what I'm thinking. I think that talent is, there's sort of a scarcity of talent, and there's a natural scarcity of talent. And I see that in sports. My son is a pretty successful soccer player. He's now U15 here in NorCal, playing at the MLS next level. And I can see it, like, no matter how much it's no matter, it is very the amount of talent, the amount of good players. Eventually, those players that really make a difference, the players that can get you to a winning team, there's only a handful of such players. It is very difficult. It is very difficult to find talent. And I think that applies to sports as much as it applies to entrepreneurship. So just throwing money at the problem is not going to increase the amount of talent. Now, having said that, you might say, but what are you talking about? Look at all these successes. Again, Airbnb, Uber, and all that stuff. Now, in my view, most of these unicorns that came out in the last decade, it's too early to say how successful they will be. It's too early to say. They're not making money. Their business models make no sense. There's another one, Instacart, which every time I almost have an ulcer when I think about it. It's a ridiculous company, if you ask me. Even Amazon, as an online shopping as a company, I would argue was not successful. What made Amazon Amazon is AWS. And this is the key. As talented and successful as Jeff Bezos is, and as great as the company is, and the market cap is high, and all these things that are, when it really comes down to the relevance, to the impact, to the satisfaction of being an investor in a company like that, I have to ask some serious questions. The same applies to Facebook and Twitter. Now, some people might say, who cares? They made money. The problem for me as an investor is, I always say that my goal is to hold as many shares as I can and never sell them unless I have to. If I have to sell for tax reasons or to cover my living expenses, or maybe, God forbid, I want to buy a house or something at some point, maybe I might have to sell something. But I want to hold as many shares for as long as I can. If I have that kind of attitude, I cannot rely on a business, let's say like Airbnb or Uber, where, well, for now it's not making money, it has lots of potential, and there's some sort of strategic value. So even if it never makes money, there's some value in there. I can't rely on that. I have to invest in a business that is relevant, that is generating positive cash flow, that is dominating their market, that is growing, that is solving serious problems in a way that it's making things 10 times better and 10 times cheaper, and hopefully even more than 10, maybe a few orders of magnitude. Those are the kinds of businesses that I need to invest in. And those types of I want to invest in. And those types of businesses, in my view, they come very rare because they can only be built by exceptional talent. And exceptional talent is very hard to come by. And yes, I think there is some value with all these incubators and Y Combinator and all that stuff, because to Farouk's point, you can de-risk the entrepreneurial experience. And if you at the margin do that properly, you might get more success. That's possible. But on the other hand, it's almost an oxymoron. If you have to de-risk an entrepreneur, well, is that really an entrepreneur? Isn't the whole idea of the entrepreneur that he has to do it? He doesn't have a choice. He has to do it. And now you're coming here with some institutional setup that is supposedly de-risking. It's a little bit of an oxymoron, maybe. And that is an open question. It's a philosophical question. I would like to discuss this more with other people in Silicon Valley, particularly maybe Jeff or Farouk or people like that, who are is particularly in this early stage investing business. I would really like to discuss that, because I feel that there's certain things in life that you can't create more beautiful women just by, I don't know, throwing money at something, or creating more beautiful women, or better actors, or more interesting novelists, or things like that. You just can't create those things. There's some sort of natural limit almost. They come along. It's I feel like it's a little bit like there's a certain percentage of people that are gay, a certain percentage of people that are autistic, geniuses, certain percentage of people that are boring. There is a certain distribution in humans, and it's very difficult to change that. You can maybe change that over time, particularly with things like democracy, for example, changes the way people express. If you express more freedom, if you can express more freedom, more talent emerges and things like that. So yes, I do think that over time, through institutional changes, you can make a change. Having said that, I think that there's a certain limit to how much change you can achieve just by organizing yourself properly. Because again, the analogy from sports, yes, you can have a very well set up team, well organized, good coaching, but there is only so much you can do. At the end, in the end, the talent is just very hard to come by. And therefore, and this is the main reason why we believe our approach actually, and this is now the conclusion to my first question, are we missing out as investors by not being invested earlier? Our point is we're not just missing out, we're at the right place. Where if we invest in companies like Caribou, just when they go IPO, we just buy the stock because we've done the work. We know what they're doing. We know them already. We know them way before they go public. But once they go public, we have de-risked it in a way that it has naturally come to the point where it's the kind of company that will generate wealth, and we don't have to deal with all the personal issues that you have with startups and things like that, and we don't have to deal with this sort of oxymoron type situation where we have to kind of de-risk the entrepreneur, but the entrepreneur himself or herself shouldn't be de-risked because that's what they do. And if they need de-risking, then maybe they're not a good entrepreneur. So this will be my conclusion. My point is, I think we're at the right place, not because we're at the right place in the investment value chain, because when you go public, and it doesn't really matter that you have tradable shares and things like that. That's a nice to have. What really matters is that at this point, you're going from de-risking the company in a sense that now it's about delivering the products and services, that the technology, that the concept, the engineering practice that you're actually building on can start delivering the fruits and generate the kind of impact that we are looking for at Orange Capital Partners. Thank you.